Hey guys, I'm Danny and this is Capitalism. And today we're going to talk about what it takes to 10x an investment and what exactly I'm doing to hopefully achieve that. But before we get started, go ahead and subscribe to the channel if you like this kind of content. And quick disclaimer, this is not financial advice. I'm not a financial advisor. This is just my opinion. Please do your own due diligence. All right, so let's get into it. So the simple answer to my question is that I'm simply being an investor, not a trader. Yes, there is a fundamental difference between the two. An investor operates under a much larger time horizon, whereas a trader operates under a shorter time horizon and tends to come in and out of the market in a much greater frequency. They tend to try and time the market, try to time the highs and the lows, whereas an investor just sits tight and hopefully is right. What I'm doing is simply that. I'm simply finding a worthwhile sector or a collection of sectors and doing the research that's needed, doing the work that's needed to get the conviction to hold through the ups and the downs. And more in particular, I am an energy and commodities investor. Why I think that is because I believe that the conditions are right. There's a supply shock in the market that we haven't seen in a long time, probably if ever. And these kind of things are cyclical. I'm going to take you through the last great commodity bull run, the last great commodity super cycle of the early to mid 2000s. And I'm going to show you what you would have had to do to get those 10x plus gains. Quick note though, we're going to start off with oil. And why oil? It's because oil is the leading indicator of a commodity bull run. Energy always runs first. Energy always leads the pack. And then you've got your base metals, you've got your precious metals coming after. And why is that? It's because oil leads input costs. For all of these metals that need to be extracted, whether they be gold, whether they be copper, whether they be silver, they're all going to need oil to power their machines to extract this stuff. And if oil goes up, the cost of pulling these things out of the earth goes up as well. And so it raises their price. So let's get into it with oil. All right. So this is a chart of WTI over the last year or so. Here, let me pull it up. And as you can see, we've kind of been chopping sideways here for the better part of two months. We're in a bit of a downtrend over the last 7 or 8 months, but keep in mind that we did come off pretty significant lows here in 2020. In fact, oil was zero and at a point negative. So to see it rise from when it was valued at literally nothing to $128, of course, we were going to get a little consolidation period. Of course, we were going to get a little cooling off period. This is not something that's out of the ordinary. It's actually healthy. It pushes out all the weak hands, and it allows people like us to get entry points, who have the conviction necessary to hold through the bad times as well as the good times. So let's go all the way back to the 2000s and see what we would have had to do to get these gains here. So oil bottomed out at around 17 bucks at the tail end of the tech bust. Now, imagine yourself in the early 2000s. Maybe you remember the tech bust. I don't know. But how hopeless it must have felt to see all of these high growth stocks come all the way down, and oil as well, down to 18, 16 bucks, whatever it is. You would have had to buy here knowing the value of oil, the innate value of this cyclical commodity, and look at all the volatility you would have had to ride. The price for gains in the commodity space and energy space is the volatility. You have to be able to stomach the volatility. Let's go through this. Suppose you bought here around 20 bucks and you held it all the way up to here to about $40. a doubling. Now, you may have been tempted to sell, but if you had the conviction necessary, you may have thought to yourself that oil has much, much broader upside. And then look what happens. Boom, all the way down to $26. What is that? A 40% haircut? That's a crash. But if you would have sold off somewhere around here just because you were shaken out by the low price, look at all of this upside you would have missed. And look at all this downside along the way. You would have had higher highs, higher lows, higher highs, higher lows. Say you held all the way up to 78, 79, 80. That's a 4x. Only to see it crash down to 50. That again, what is that? A 40% haircut. But if you would have stuck to it, you could have rent oil all the way up to $150. Let's look at uranium next. Let's look at uranium through Cameco. And why Cameco? Well, Cameco is the head honcho of the uranium miners. It's the biggest uranium producer here in North America by way of market cap. And look at Cameco in the early 2000s. If you were a uranium bug, let's say, and you bought somewhere around this area, right? Let's say you bought around $2 and you held it at $4. Wow, that's a doubling. And you didn't sell. Boom. Drawdown back down to $3. That's a 25% correction. Would you have been shaken out? Or maybe you weren't shaken out. You would have been rewarded with a price hike all the way up to near 10 bucks. That's a 5x from your initial investment. And it would have taken 4 years to do so, from 2000 to late 2003. 3 years. Only to see it drop back down to $7.50, $7. That's a 30% haircut. But if your conviction was still strong enough, you could have held on to $25. That would have been a 12x from your initial investment. And it would have taken 5 years to do so. From 2000 to 2005. What would you have done? Would you have held on? Would you have sold? Would you have taken profits? Let me know in the comments below. Only to see it drop back down to 17. Another drawdown. More volatility. But if you would have held on all the way out to, let's say, here to $56, what is that? A 25x. A 25x. And you don't even have to capture this entire thing. No, very few of us will ever capture the bottom and the top. But let's say you're a late adopter into uranium. You've been seeing it doubling. You saw it double from its low in 2000, and you decide to pile on sometime around here, right? You saw it double, and then you saw it correct down to $3. That would have been a good entry point. And say you would have written it all the way out to $30 here, 2005. Well, that may not have been a bad idea, because you would have had to wait another 2 years just to see it go from 30 to about 56. And that's a little less than a doubling. You would have had to wait 2 years to see another doubling. But had you waited from 2003 all the way out to 2005, you could have gotten a 10x in 3 years. So the idea is the price for these humongous 10x gains is volatility. You have to be able to stomach the volatility. And how are you going to do that? Well, it's by doing the research. It's by doing the work. You've got to do research on this sector, on this company. Otherwise, you're going to be shaken out. You're going to be lettuce hands. You're going to be little soft hands. You're going to drop it. Someone like me is going to buy it from you, okay? Let's look at Paladin. Paladin is also one of the bigger names in the uranium space. But back in early 2000, it didn't have nearly the same market cap that it does today. So let's go all the way back in time to 2000 and let's say 1. Let's treat it the same way as Camco. Let's zoom in on 2000. Here we are. Paladin actually reached a cent at some point here in 2003. Many of you may have heard the story of Rick Rule buying Paladin at 10 cents, somewhere up here. I don't know where it is, somewhere up back here somewhere. Only to see it drop a cent. But the fact that Paladin went from 10 cents to a cent actually made Paladin more attractive to Rick Rule. Why? Because Rick Rule saw the value in Paladin. To see a 90% sale on Paladin made it more attractive for Rick Rule to buy. And Rick Rule bought more at a cent after seeing it drop 90% of its value. And if you would have been someone who would have bought after the initial rise up, let's say, you're not going to take the chance of buying a penny stock, a literal penny stock, only worth a penny. But let's say you saw it go up to 5 cents up here, a 5x. Okay. You buy it here in 03 and you hold this thing. You hold this thing, it goes all the way up to 15. That's a 5x. That's a 5x in what? 2003 all the way out in 2004 in a year? That's insane. But look what would have happened. You would have been so distraught. You would have been so angry. I mean, at least I would have been. Back then. I wouldn't be angry today like I am now. But back then, some of us who may not have known any better may have thought, oh, well, I've lost my chance to sell. The thing went from 15 cents and now it's all the way back down to 7 cents. It's lost 50% of its value, actually more than that. But knowing what we know now, knowing that the price for these huge gains is volatility, is the ability to stomach volatility, you would have had to held on. And look what would have happened. It would have taken you from 2004 all the way out to what is this? Well, you're still 2004, from May to October. You wouldn't have had to wait too long. You would have gone from 7 cents to 65 cents. You would have 10x'd your position if you would have bought more at 7 cents. And that's not, there's still more. You would have seen a drawdown from 63 cents down to 41 cents. That's a 33% markdown. But then you would have missed out. If you would have sold, if you would have been shaken out, you would have missed the move to $1. And again, what if you would have bought this at 5 cents, somewhere around here, or 10 cents, somewhere around here? There's your 10x right there. But wait, there's more. If you would have still held on, you would have had to stomach a 30% drawdown, a rise back up to that dollar mark, another drawdown, but then you would have made it all the way up to $1.50. But let's see if you just held on for another couple of years, you would have gone all the way out to about 9. Let's see, is that the top? Yep, about 9.50. That's 100x if you would have bought it at 5 cents. Sorry, that's a 200x if you would have bought it at 5 cents. And that's a 100x if you would have bought it at 10 cents. After seeing a 10x from a penny to 10 cents. Even if you bought it at $1, what is that? Around here. Even if you would have just waited 5 years or 2 years from the initial run up, you could have still 10x. So that's the beauty of these things. You don't have to get the entire move up. But even if you just capture a piece of it, maybe here or here, You can easily you can 10x your money if you have the conviction necessary. Now, I'm not saying Paladin is going to do the exact same thing today, but they're these energy stocks, these energy trades, they are explosive in their returns. And it happens over and it happens over and it happens over and over and over again. Let's look at coal. This is NHC. Look at its low. Look at its low from '03 at 62 cents. And look at all this volatility you would have had to endure just to 10x in August of 2011. You would have had to held from 2003 to August of 2011. That's what? 8 years? Would you have been able to do that? And along the way, you would have had to see your 10x here get sliced in half. You could have gone from 6.59 cents all the way up to 5.65. That's a 10x right there. Only see it sliced in half. Only see it move back up to 6.55. Now, honestly, in a perfect world, in an idealistic world, this would probably have been the best place to sell. Okay? You would have gotten your 10x or somewhere close to that. You know, say you buy around here, whatever. And you wouldn't have had to wait another 3 years just to see it doubling. Time horizon also matters. If you're going to have to if you're going to have to wait years just to see a doubling, then the asymmetry just simply isn't as appealing as it once was. Asymmetry is when you have massive upside like you do here and limited downside. Do you see that here? No. So we've got to make sure that we're putting our emotions to the side. We're buying when everyone hates a stock, when no one knows what it is, but you've actually put in the work and can identify its value, and you want to sell once it becomes a mania. Once you see the guy down the street, your neighbor, talking about buying coal. That certainly hasn't happened yet. Even though we've run up from $1, let's say let's call it $1 here in NHC in 2020, all the way out to $7.50. We've seen a 7x in NHC, this coal stock. But I'm still in it. I'm in NHC. Why? I don't see anyone talking about coal. There is no positive or negative sentiment on coal because there simply isn't any sentiment on coal. Coal, I believe, is still under the radar. As long as these things are under the radar, guys, I don't think we've hit our top. And as long as these things are pivotal for the functioning of society and the supply shock continues to hamper inventories on the supply side, I'm going to stay in these things. I've done the work. I have the conviction. Let's look at natural gas. This is Range Resource Corporation. You look at this level here. After the tech bust, about $1. Went all the way out to $100 almost. 100x. You could have seen $1 go up to 5.17, a 5x, and thought to yourself, okay, well, this thing is run. It's time to sell. The commodities trade is done and over with. We've already 5x. You know, that's a 400% return. Can't get much better than that, can it? Well, yes, it can. You know, you would have had to deal with a 50% correction for about a year or two. But then look what happens here. You go all the way up to 30. It's another 5x. Peter just held on. It's 25x from the start. Assuming you bought the bottom. And look at all these strong corrections. Going from 77 down to 2024. So what, a 60 or 70% drawdown? Would you have been able to stomach that? And you could have finished with 100x. And again, I mean, ideally, I think that the time to get out was around here. You've got a 74x move from the bottom. You're probably not going to capture that entire 74x move, but if you capture, just say, if you bought it at $5 and you say you sold at 550, there's your 10x right there. And you would have only had to wait from '01 to '07. That's 6 years. Okay. The problem with waiting through, when prices get a little too high, the returns also get limited. So you would have had to wait from '08 to 2014 just to see what, a 50% move. It's, in my opinion, it's not worth it at that point. So this is copper. So as we talked about before, metals move after energy. So look at the move in copper in 2000, going from 70 cents a pound all the way out until we reached 411 a pound. It's a 5x move right there. We've already had a pretty big move in copper, but I think I still think copper is a pretty strong trade. And again, copper is one of the best indicators for describing the strength of the economy. So the more copper we use, the more production is ongoing within the economy. Here's a copper producer, FCX, one of the biggest copper producers in the market. You can see it's low at 374 in 2000, and it's high at 64. So that's a 20x right there. And then look at all this volatility. All this volatility. Silver is interesting. Silver is both a precious metal and an industrial metal. It not only has precious metals capabilities, but it also has industrial metal components as well, because it is required in the manufacturing of silicone chips and batteries, etc. So silver, what we've seen in the past with silver is pretty interesting. So this is what's called a Livermore cylinder. And what's interesting about the Livermore cylinder is that we can find it in a number of different stocks and indices. This was penned by Jesse Livermore. He basically invented technical analysis in stocks, and this is basically the pattern that we saw in silver: an ascending cylinder up, followed by an explosive move to the upside, and then a crash down. And this is what we saw in cylinder. This is what we saw in silver in the early to mid 2000s. It's this Jesse Livermore cylinder pattern. Silver was priced at $5. It went all the way out. It ran through this consolidation area, and then exploded all the way up to $51. That's 10x in about 9 years. But you would have had to endure all this volatility along the way. Maybe you hold on through this volatility. Okay, maybe you hold on in copper here. Maybe you just buy more, for example. Maybe you just buy more here. If the trade isn't done, you might just want to, not giving you advice, I'm just putting it out there. Maybe I could have, just my opinion, maybe you could have bought more here, just held on, ridden this all the way up, captured this movement here from $9 to 50. It's a 5x, nothing to scoff over. And then this is EXK. This is a silver miner. Again, the same Livermore cylinder. Hit our heads on it a few times, and boom. Explosive rise to the top. Go from 67 cents to $13. You don't have to time this thing perfectly to get pretty decent returns. And this all happened within the confines of what, 4 years, from '08 to 2012? It's pretty good. I'd much rather get a 10 bagger in 4 years and have to wait 10 years for it. What do you guys think? So that's what I got for you guys today. Let me know what you guys think. Are you invested in commodities and energy? And do you think that the energy trade is over? Do you think that the commodities trade is over? Do you think that we've topped out? Let me know in the comments below. And if you like this video, go ahead and give it a like. And go ahead and subscribe to this channel for more content like this. All right, guys. You guys have a great day. Talk to you later.